Here is your
April
receipt.
1933. A bank lobby smells like ink
Thank
and
you,
damp
miss.
paper.
Thank you,
A
miss.
teller slides a form across the counter. A small pile of gold coins sits between two hands. Not stolen, not found, not smuggled, just owned. No, the paper says it must be turned in. The coins are heavy, the kind of weight a person trusts. A few minutes earlier, they were savings and privacy. Now they are a problem in a public emergency. Behind the teller, a notice is tacked to a board. Bring gold coin, gold bullion, and gold certificates to a bank. Do it soon. Do it by the first day of May. The teller does not threaten. The teller points to the signature line. In this moment, power is not loud. It is administrative. It lives in paper, stamps, and deadlines. The order has a name that sounds like a file number. Executive Order 6102. It was signed by President Franklin Delano Roosevelt in early April. It says the hoarding of gold is forbidden within the continental United States. It says private gold must return to the system. To understand how an order like that becomes possible, you have to step back a few years. The crash comes, then the long collapse. Factories slow, farms fail, wages fall, banks close their doors and do not reopen. Adults stand on sidewalks, staring at locked entrances. When a bank fails, money stops being an idea and becomes a fear. So people do what people always do when trust breaks. They reach for something they can hold. Gold is not just a metal in those years. Gold is a rule. Paper money is tied to it, and the world watches that tie. When confidence slips, gold becomes a target. People withdraw coins and store them in cans, boxes, and safe deposit vaults. They do not call it hoarding. They call it survival. In March of 1933, the United States is on the edge of a full banking panic. Franklin Delano Roosevelt has just taken office. Within days, the banking system is shut down in a national bank holiday. It is a pause forced by crisis. Behind closed doors, officials try to stop a stampede. Emergency laws are passed. Banks reopen under new rules. Conversions are restricted. The message to the public is steady. Trust the banks. Trust the recovery. But trust is fragile. If paper is a promise, gold feels like the exit. In Washington, another problem sits behind the scenes. The Federal Reserve needs gold reserves to support the currency it issues. Under the rules of the era, the system cannot expand freely if gold drains away. Deflation has been crushing the economy. Prices fall, debts grow heavier, businesses suffocate. Policymakers want room to push money into circulation. Gold hoarding stands in the way. In late April, another proclamation tightens the system further. Gold exports are blocked. Treasury offices and financial institutions are told not to convert currency and deposits into gold coin and ingots. The point is simple. Stop the outflow. Stop the conversion. Stop the collapse of reserves. The country is being steered away from gold as a daily promise. So the administration chooses a weapon built from law and emergency authority. It uses powers tied to wartime statutes and banking emergency legislation. It treats private gold as a leak in the ship. Plug the leak. Keep the vessel afloat. The order arrives in bank lobbies and post offices like a storm that does not look like weather. Printed notices appear. Newspaper headlines spread the message. Deliver gold coin, gold bullion, and gold certificates to a Federal Reserve Bank, a branch, an agency, or a member bank of the Federal Reserve System. Do it on or before the first day of May, 1933. The deadline creates a new kind of line. Adults arrive, holding small sacks, envelopes, and wrapped bundles. Some carry coins kept for years. Some bring gold certificates tucked into ledgers. Some hesitate at the counter, unsure whether their paper is a gold certificate or another kind of note. Clerks point to the yellow ink and the special wording. Confusion becomes part of compliance. The order contains carve-outs. Gold used in industry, profession, or art is allowed. Gold coins with recognized special value to collectors are allowed. A small amount of gold coin may be kept, up to $100 in face value. Everything else must move back into official channels. The penalties are not written as a suggestion. Violations can be punished by a fine of up to $10,000, by imprisonment of up to 10 years, or by both. In the lobby, those numbers hang in the air even if no one says them out loud. This is not advice. This is an order. The teller takes the coins. The teller counts, weighs, records. A receipt is issued. In exchange, paper currency is given at the official rate. The customer leaves the bank with a different kind of money and a new kind of doubt. In a back office, the coins do not stay on the counter. They move into canvas bags. Seals are pressed into wax. A manager signs a ledger line by line. Later, a courier carries the bags through a locked door into a vault room. Shelves of metal boxes wait in the dim light. This is what centralization looks like. Not dramatic, just relentless. Outside, the city continues. Street cars roll. Shoes hit pavement. Lunch counters serve coffee. To anyone walking past the bank, nothing looks strange. But inside, an invisible contract has shifted. Private ownership has been narrowed by emergency. Not everyone complies easily. Some people argue that gold is theirs, bought with their labor. Some fear inflation, fear manipulation, fear betrayal. Some believe the government will change the price later. Some decide to hide what they have. In a rented room, an adult man opens a small tin. Inside are coins wrapped in cloth. He turns one over and watches the light catch the face. He thinks about the order, the deadline, the penalty. He thinks about what it means when a government can rename what is lawful. Downstairs, a neighbor reads the newspaper out loud. Deliver gold to the bank. Get paper in return. The neighbor says it will help the country. The man does not answer. His silence is a choice. At the same time, the machinery of compliance grows. Banks create procedures. Federal Reserve branches prepare vault space. Treasury officials issue guidance. Posters go up. Forms multiply. The system turns a dramatic act into a routine. By late April, the order is no longer a shock. It is a calendar item. People remind each other of the deadline. Some move quickly, afraid of being accused. Some wait until the last days, hoping the policy will soften. But the pressure remains. On the first day of May, the legal line is drawn. After that date, gold held outside the exceptions becomes contraband in the eyes of the federal government. A person can still own jewelry. A dentist can still use gold for work. A collector can still hold rare coins. But the ordinary citizen cannot keep gold coin as money. That is the first crack. The second crack comes in contracts. In early June of 1933, Congress passes a joint resolution aimed at gold clauses. These clauses were promises written into bonds and leases, promising payment in gold or in currency equal to gold. Now they are declared against public policy. Obligations are to be discharged in legal tender, dollar for dollar, not in gold. The government is not only collecting gold, it is rewriting the terms of old promises. In an office where a small business keeps its books, a contract is reread. A clause that once felt like protection now reads like a trap. The numbers on the page do not change, but the meaning does. A promise to pay in gold becomes a promise to pay in whatever currency the law recognizes today. The paper has not moved, but the ground under it has. In Washington, the administration continues the gold program. The goal is not simply to gather metal. The goal is to control the monetary system in a crisis. Gold is centralized. Then the structure changes again. In January of 1934, Congress passes the Gold Reserve Act. It moves the gold of the Federal Reserve to the United States Treasury. It creates a stabilization fund within the Treasury, built from the profit of revaluing gold. It is the next step in turning an emergency program into a permanent financial instrument. Then comes the moment many people feared. The official value of gold is raised. The dollar is devalued relative to gold. If you turned in your gold at the earlier official price, the new price tells you something cold. The government now holds the metal, and the metal is worth more in official terms. That difference is not only a number. It becomes a tool, money inside a stabilization fund, ready to be used to influence the value of the dollar in a nervous world. Supporters of the policy argue that the economy needed it. They argue that rigid ties to gold were choking recovery. They argue that stopping gold outflows helped stabilize banks. Critics argue that it was confiscation and that it punished savers. Both sides point to the same documents. The difference is the story they tell about necessity. The evidence is in the paper trail. Executive Order, 6,102 sets. The deadline and the requirement. The Gold Reserve Act transfers the gold and changes the structure. The joint resolution voids gold clauses in contracts. Each step is signed, published, filed. Each step is legal. Each step is also a statement about power. In the Supreme Court, the fight reaches a high ceiling. Cases about gold clauses arrive in 1935. Bondholders and contract holders challenge the government action. They say a promise is a promise. The court upholds the broad authority of Congress over money, and the joint resolution remains in force. The crisis-era measures are treated as policy, not a temporary fever. A dissent warns about broken obligations, but the majority view becomes the rule the country lives under. Back in the bank lobby, the human cost stays quiet. There is no single dramatic scene for most people. There is a receipt, a stack of paper bills, a tin now empty. There is the uncomfortable thought that savings can be redefined by law. The man in the rented room finally walks to the bank. The coins in his pocket feel heavier than before. At the counter, he slides the bundle forward. The teller opens it, counts, and writes. The teller hands him paper. The exchange is clean, almost polite. That is what makes it unsettling. Outside, the man stands on the sidewalk and looks at his palm. No metal, only paper. He tells himself, it is still money. He tells himself, the country will recover. He also learns a second lesson. Sometimes the government does not need to break into a home to take something. It only needs to change the definition of what you are allowed to hold. It can turn possession into a violation with ink and a date. Decades later, the world moves away from gold as a daily rule. Restrictions on private gold ownership are lifted in the mid-1970s. People can buy and hold gold again. But the memory of the order remains, especially in moments when trust shakes. The story is not only about gold. It is about what happens when a financial system is built on confidence and confidence collapses. It is about the tools leaders reach for when panic spreads. It is about how emergency measures become normal procedures. If a new crisis arrives, the question returns. What asset becomes the next leak to plug? What rule becomes the next signature? What will the forms on the counter demand next time? The demand next time. The demand